Okay, so welcome to Module 6, Lesson 2, Credit Card Crash Course. And the question is, what is credit? Well, credit is the ability of a consumer to obtain goods and services before payment based on an agreement between the lender and the cardholder. Wait a minute, I missed a skip, didn't I? Based on an agreement to pay later. All right. It is a Okay, so it's a convenient line of credit. This means that it can be used repeatedly. The credit card company charges interest, the price of using someone else's money. If the cardholder does not pay the full statement amount by the due date, the credit card companies add fees. Interest to the balance. A credit card is an unsecured loan. Credit has to be pretty good to get an unsecured loan. This means that it's not backed with collateral. This is the one where you can use it to literally go out to eat, go to the movies, go on a trip. Not any, use it on things that aren't tangible. So you don't have to be buying property like a car or a truck or a house or furniture that the lender could get their hands on if you don't pay. And it's offered by the borrower as a guarantee of payment. Okay. The interest rate of credit cards is really quite high. Most of them are, 17%. They charge you, so 17% of your money is going toward, more than 17, going toward just to pay the interest. So this is a kind of short lesson. It's not real long. It's the end of Unit 6. So let's look at what we got. We got some types of credit cards that we can talk about. Examples as Visa, MasterCard, Discover. Those are the big companies. They're issued by banks, managed by credit card companies. Credit card companies make money from charging a fee with each credit card transaction. Store-branded credit cards, for example, you could have a Target credit card, a Walmart that you can only use at Walmart, or Sam's card, and maybe the Gap store. You can have a Gap card, I guess. Typically have higher than normal, higher interest rates than other cards, but may give some special discounts. Now, oh yay, half my Christmas gets bought with my Walmart credit card or my Sam's credit card. The discounts I get, I save them up and use them at Christmas to buy Christmas presents. So incentives are perceived benefits, just like that. I rack up points and use those to exchange for money to get things at Christmas for the kids. So these are benefits. that encourage certain behaviors, like pay your bill on time, charge $100 a month, whatever, charge and pay. Credit card companies offer incentives to entice consumers. Come on over to our side. Examples: pay your bill on time will lower your interest rate. You can come into our store today with your credit card and receive a 20% discount on groceries. Or you can rack up some reward points that you can use for a getaway vacation to the Bahamas over Thanksgiving when it's cold. That type of stuff. Okay? On this next page, we're going to talk about credit cards and consumer protection. The Truth in Lending Act. Okay, so this is a federal law that mandates full disclosure of information about the cost or the terms of your credit. So they can't just up your interest rate without letting you know they're going to do so. That's what that amounts to. Okay, so another thing it does is protect us, the consumer, against unauthorized use of our credit cards. So if somebody uses your credit card, like you go into the gas station, swipe, somebody's employed there, they pick up your number and they start racking up charges in your name, that wasn't you. You shouldn't have to pay for that. And that's what the Truth in Lending Act takes care of. This Fair Credit and Charge Card Disclosure Act mandates a box on the credit card applications that describe features and costs. Key features, just like that. So this Credit Card Act 2009 requires additional info in what they call the disclosure box. They have to disclose, which just means they have to tell you all their little secrets before you say, yes, I want that. It limits the fees and the rate increase. It requires consistency. In the payment date and times. So 1 month it can't be, oh, my credit card's due on the 5th, the next month the 20th, the next month the 3rd. You have to have a consistent date and time that's the cutoff to pay the card. Also, it addresses the what happens if you go over the limit. So it should be a credit limit. So let's say you got a card and your limit is $500 and you just are dying. You've spent $350 this month, but something's come up, you really want it so bad you can't stand it. So you go ahead and go over your limit and spend that $200, put you over the limit $50. So if you do that, which some cards will let you do, not all, but you have to know what's going to cost you, because it may not be worth it. Maybe just wait a month and get the thing, unless it's just something that was worth $5,000 and you could get it for $200. I'd probably be all over that, It also states that any consumer under the age of 21 must demonstrate that they are able to make payments, or they must have what we call a parent. It don't have to be a parent. A co-signer. Somebody that's over 21 that already has some credit that can say, you know what, if they don't make their payment, I'll do it. And I'll pay their fees if they get fees. If they don't, I'll do it. Dangerous position. I've been there as a mom and didn't get burned. I've been there as a friend and got burned. So you just have to be careful about that. Okay? So you've made a decision to use credit. Now what? Couple of things. you need, when you're making your credit card payments, the summary of your account activity, which is the summary of the transactions on your account. And those include payments, credits, debits, purchases, balance transfers, didn't spell that right, transfers, got an S in there, your cash advances. You know, that's the good thing about a credit card. If you don't have anything on there, you need $200 to go somewhere, do something, you can use the credit card to get a cash advance. Your fees, your interest charge, and if you've got anything of your amount past due. All that information's on there. Payment information shows your total new balance, the minimum payment amount, and the date that your payment is due. Last thing you want to do is take out a credit card and start missing payments on it. It'll ruin your credit quicker than anything. Late payment warning states any additional fees. And the higher and the interest rate. That's what I wanted to put here. Higher. The higher interest rate that may be charged if your payment is late. Minimum payment warning gives you a estimate of how long it can take to pay off your credit card balance if you make only the minimum payment each month. And an estimate of how long or how much you are likely to pay in the long run. Your transactions are a list of all the transactions that have occurred since your last statement. Including purchases, payments, credits, balance transfers, so money transfers, and money cash advances. Anything you use that card for, you're going to get on your transaction statement. You do have fees and charges to pay, okay? If you're late, they're really going to rack you up on some fees. If you go over your limit, it's really going to cost you over your limit. But you know, there's a magic window, and I didn't know this until about, I guess 5 years ago. She was 19, my daughter's 25. She had a credit card with a $500 limit. All the kid did with that credit card was use it to make her car payment, and then she'd pay the car off. The difference was, like, she got paid on the 15th, her car payment was due something like the 10th. But this card she was using to make her car payment on time, as long as she paid that card off before the 26th, she didn't even pay interest on that money. So pretty smart, in my book, that she was using her card every month to pay her car payment on time no matter what. And then after the 15th, she had a little window there to pay the card off without being charged any extra interest. It really helped her credit score go up, really racked things up for her. A notice of charges to your interest rate if you trigger the penalty rate. That's when you don't pay like you're supposed to. There will be a penalty rate. Your credit card company may notify you that your rates will be increasing. Okay? So the last bit here to talk about is how much is too much. Well, if you can't pay for it, it's too much. Deciding how many credit cards you need. You may be tempted once you get a credit card. A lot of people are. A lot of people are tempted to get several and overspend. Don't let that happen to you, okay? Deciding how much credit is too much. What we call your debt, DEBT, debt to income ratio, determines that. It's a number that determines whether you have enough income to meet your monthly financial obligations, including your mortgage, if you have that, payment, and still have enough money left to live on. Just take into account everything you pay in a month that you have to pay, and that is financed, like a mortgage payment, a car payment, financed items. And your debt to income ratio should not exceed 36%. That's what they say. So, if you make $1,000 a month, $360 a month is your credit limit. They expect you to need the rest of your money to live off of. Your monthly housing payment, comprised of your mortgage plus your property tax, your insurance, is all added to your other monthly debts, such as your credit cards, car loans, student loans, etc. To find out your DTI, your debt to income ratio, okay, debt to income, you take all this stuff and add it together. Then you divide it, this sum, by your gross monthly take-home pay. For example, if your total monthly debt payment is $200, that's all that, total monthly debt, $200. Then we're going to divide that by our monthly take-home pay is $1,200. Then, after we divide that, we're going to multiply it by 100 because we want to know what the percent is, right? So it is 16.6%. So you're only at 16.6%. You spend another 20% of your money every month and have another payment. So if, like, you had one car payment right now, you were a teenager living at home, you bought you a used car, you're doing pretty good. 16.6%. And having a great credit score with no verifiable income is not a good thing. So be careful with that. Okay, so that is the end of what was we doing? 6.2. Good luck.